Welcome everyone to a new update. Today we'll be covering everything you need to know about indicators which you can use if you want to trade. But before we're going to continue, make sure to subscribe to this YouTube channel beneath and like this content and this update if you like what we are doing. Yesterday we've posted the first video on YouTube regarding the recession and the global economic outlook, and we were live on Friday as well. Next week we'll be live on Monday and Wednesday additionally. If you like what we do, our trade ladder and recently added premium membership can be tested for 1 week for free. The links in the description gives you all the information you need to join for free. Then finally, FTX is our core sponsor on this YouTube channel, and therefore we are able to do a big giveaway. We're giving away 3 one-year memberships to our platform 8 Global, where I'm sharing my trading portfolio, trade IDs and more. In order to do that, you will have to sign up to FTX through the links in the description beneath and trade on there, and then you will be able to win those prizes. I know that some of my viewers are either completely new to the world of trading or have been completely taken by surprise by the current bear market and are now in a phase where they need to start learning all over again. I want to help you with this. In addition to one of the latest videos available on my YouTube channel, How to Survive a Bear Market, I hereby present you with the next step, which is the basic indicators, and that's what we're going to discuss today. When you start with trading, you often need additional information which will help you to determine further price movements. It can be as simple as some lines through the candles, as you can see in the image behind me. Today I'll walk you through a number of basic indicators which helped me at the beginning of my trading career, as I hope they will do for you as well. The more experience you get, the less indicators you will probably be needing. The indicators we'll be discussing are volume, relative strength index, moving averages, Bollinger Bands and the TTM squeeze, but first we'll dive into Tradingview. Before we dive into the individual indicators, a brief recap. Analyzing price movements is an essential step in eventually executing trades. This analysis takes place on Tradingview. And Tradingview is a platform where traders or investors can follow all price movements spread over all asset classes. Price movements are the result of a lot of different units, such as human actions, the economic situation, supply and demand, psychology and much more. Traders can anticipate this by looking in these charts for patterns and common actions that are often accompanied by a similar outcome. As you can see, Tradingview is essential for success as a trader or investor. The platform is free to use, but the further you get in your development, the more features you want. To help you with this, I've started a collaboration with Tradingview in which you will get a discount when you purchase a paid subscription. You can obtain this via the link at the bottom of the video and in the description. Let's dive into the indicators, and the first one we'll be discussing is the volume indicator. We'll start with one of the most important factors to clearly understand, which is volume. Volume in itself is not an indicator that sends a signal about, say, overvaluation, momentum flips or anything like that. What volume reflects is how much of a particular crypto is traded within a given period. Volume conveys information about price behavior that allows us to better estimate what the next price movement will be. Behind me we have the Bitcoin price in grey and black candles. At the bottom of the chart you will find the volume indicator, and it is a fairly simple indicator to read. It gives a representation of all trades during a specific given period. This can be at any time frame from the 1 minute to the yearly charts. It is a listing of both buying and selling, of which you can see in the buying power in green and the selling power in red. In a general sense, volume is used to demonstrate the strength of a trend. So in the following example, you can see the Bitcoin run of the past year. Initially the price went up, but simultaneously it could be seen that the volume decreased. Over time, the price also followed the decline until the moment where we are now. If you analyze a price movement and expect the price movement upwards or downwards, you want this to be seen by several people. The more people that look at the charts in the same way, the more people will enter this trade. So in preparation of the trade, you want to see the trade volume increase. If the volume is increasing and the trade is breaking out, then you have acted in a good way. In the following example, we look at an ETH chart. here you can see that the price clearly continued to fluctuate around the support level, but after testing the level several times without receiving any new buying power, the price dropped through the support level with a huge amount of new sellers. The increase in sellers was the signal to go short on this Ethereum trade. The bottom line is that volume gives you extra confirmation when executing a trade. When price movements and volume coincide, you will have the extra confirmation you need to execute off your trade. Now you understand the basics of volume, and therefore we are going to dive into the next one, which is the RSI indicator. The RSI is a trading indicator that focuses on demonstrating the strength of a price movement. In other words, the relative indexing of strength. So you can see how strong or weak a price movement actually is. If the price of a coin is rising, then as a trader you're looking for how long this momentum can continue. The same goes for the situation when the price of a coin is falling, and we look for the scenario in which the probability of a trend reversal increases. Here we use the RSI. There are two methods of using the RSI for trading strategies, namely 1. Oversold and overbought, and 2. Divergences. Oversold and overbought are terms for when a crypto is bought or sold too much and too quickly, which causes the probability of a trend reversal to increase. Typically, the range between a normal RSI falls between 30 and 70. Between 0 and 30 it is oversold, which is a buy signal, and between 70 and 100 is overbought, which could be a sell signal. In this way, you can easily see if the market is overextended upwards or downwards, increasing the probability of a reversal. So for you, a signal to execute an action. As you can see very clearly in the example behind me, an oversold and overbought RSI indicate the moments when the market can start to reverse. In this case, it indicated the exact top of the bull market and bottom of the bear market. But beware, in say a strong uptrend, the RSI can be in overbought territory for months before it makes a reversal. It is a lagging indicator and thus can never be seen as leading. An RSI divergence is a situation when the RSI moves in the opposite direction of the price. Normally, the RSI of a cryptocurrency rises when the price also rises. The same is true when the price is falling. However, it can sometimes happen that the RSI rises while the price falls or vice versa. In many cases, this can be a signal that the trend is about to reverse. We distinguish two RSI divergences. A regular divergence, a reversal sign, or a hidden divergence, which is a continuation sign. In the example behind me, you can see what these situations look like. We speak of a bullish divergence when the price is falling, but simultaneously the RSI is rising. In the chart behind me, we see that the price makes a clear lower low. However, the RSI is making a higher low, which means that the regular bullish divergence is occurring. This divergence has played out nicely, and in combination with the support zone would have been a nice entry. When you take the reverse situation of the bullish divergence, you get the bearish divergence. In other words, when price shows an increase and the RSI shows a decrease, which you can see in the chart behind me, price has made a clear higher high while the RSI is making a lower high. This marks a regular bearish divergence which has played out nicely as price has immediately shown a bearish reaction. A hidden divergence is a continuation signal which indicates that there is a big chance that the price action will continue in the direction of the trend. So a hidden divergence can be used to enter or to de-risk in the middle of a trend, preferably in combination with the horizontal support or resistance zone. As the chart behind me shows a hidden bullish divergence, it is forming as price is making a higher low while the RSI is making a lower low. In combination with the horizontal support zone, this would be a good place for an entry. As can be seen in the chart, the price is making a lower high while the RSI is making a higher high, as a result of which a hidden bearish divergence is taking place. After this divergence, a bearish reaction immediately takes place, and thus this hidden bearish divergence in combination with a resistance zone was an excellent place to take profit or to de-risk. Use the RSI as an extra signal for yourself to show where the price is going to move to. This can be in the form of undervaluation or overvaluation or through divergences. This way you can anticipate upcoming trend changes or play the continuation. What are moving averages? The moving average shows the price based on average values over a certain number of days. In this way, the price trend becomes more easily visible. We distinguish a number of different moving averages, but the most important ones are the following. Simple moving average, which is called SMA, moving average, MA, exponential moving average, which is EMA. In today's video, we are going to zoom in on the EMA because, apart from price fluctuations in the past, these also take the current price into account. EMAs therefore react faster and are therefore more suitable for short-term crypto trading. As mentioned before, the EMAs represent an average value of the price of a certain period of time. They work like any other moving average indicator, where the primary aim is to identify the market trend. If a crypto asset is within an uptrend, the price will be above the EMA. For a bearish trend, the price should remain below the EMA. If you add the EMAs to your chart, you will often use them as dynamic support and resistance. Here behind me you can see an example of the 200-day EMA in the price of Bitcoin. One rule of thumb may be that when the price is above the EMA, you are in a bull trend and the EMA serves as support. If we are below the EMA, we are in a bear trend and the EMA serves as resistance. The most commonly used values for the EMA are 50, 100 and 200, suitable on any time frame, but the higher the stronger. Here you can see them all in the chart as well. The price is currently below all EMAs and so these now also serve as resistance. Because EMAs, just like any other lagging indicator, use information from the past, you can never determine your trades based on one single value of this indicator only. Bollinger Bands is an indicator that works with mathematical models from statistics. The bands are based on the SMA and by means of a standard deviation the upper and lower bands are calculated, which together create a dynamic trend around the price. The composition is as follows. 20 SMA middle band, 20 SMA plus 2 standard deviations is the upper band, 20 SMA minus 2 standard deviations is the lower band. The distance between the lateral bands depends on the standard deviations. Thus, the bands narrow when the market is calm and widen when the volatility increases. Based on the mathematical statistics, the price movement should be 95% of the time within the upper and lower band as I've described before. Two of the most critical trading systems provided by Bollinger Bands are a Bollinger Bounce and a Bollinger Squeeze. The Bollinger Bounce former is a trend reversal strategy whose main idea is that the price tends to bounce back to the middle whenever it touches one of the bands. Thus, when the price touches the Bollinger Band's upper band or upper line, traders would usually go short and vice versa. To put it in context, you can think about the bands as dynamic support and resistance levels. The relevance of the bands increases with larger time frames. Hence, this strategy is suitable for swing traders who used to leave their positions open overnight. The Bollinger Bounce works better during sideways trends when the volatility is relatively low. If the bands are expanding, then you should give up trading the Bollinger Bounce strategy because the price is forming a new trend. During low volatility, you can use the other strategy, a Bollinger Squeeze. When the bands squeeze together, you should be ready for a breakout. If the price breaks above the top bands, traders are opening long positions as the price is expected to continue to move up. If the candle breaks out below the bottom band, traders go short because the price will continue to go down. The TTM squeeze is not really an indicator where you look at support and resistances, but more about momentum. Let me explain. The TTM squeeze indicator is a volatility-based indicator that shows when a currency will change from a trending market to a declining market and vice versa. In short, it shows when a market has bullish or bearish momentum. The same goes for bullish or bearish momentum overall. Main components: red and green dots on the 0-point histogram. A transition from red to green indicates a squeeze in the market. The second one is the histogram, and the histogram indicates whether the value of the token is going into upward or downward momentum. If the lines of the histogram rise above the zero line, upward momentum is expected. If the bars of the histogram are below the zero line, downward momentum is expected. In addition, you can also see differences in color. A light color is the increasing momentum and a dark color is decreasing momentum overall. An example about bullish patterns. Light green is increasing bullish momentum, dark green is decreasing bullish momentum. In the chart behind me, I've written out two different scenarios where this TTM squeeze could be used to excellent effect to play the changing momentum. The first scenario is where we see a short-term bear market in a major uptrend, which means a pullback in price. When the TTM turns dark purple, meaning decreasing bearish momentum, we see that the momentum changes and the price bottoms. From that moment, Bitcoin rose 123%. In the second scenario, one of the most infamous moments will be discussed, which is the double top of 2021. At the moment when the price of Bitcoin makes its first new all-time high, we actually see that Bitcoin's momentum is already declining tremendously. So the second rally towards 96k was done with much less buying power and thus buying momentum and was doomed to fail. After this TTM signal, Bitcoin lost 73% of its value. With trading and investing, it's not about having as many different tools and indicators as possible. It's about developing a strategy which ensures that you can make comfortable, successful decisions, and indicators can add to this. In today's video, I've taken you through a number of basic indicators, some of which I still use myself. Do not use these as guidelines, but as an example about what is possible in everything with trading. Practice, test, try, and make sure that you get a step ahead in analyzing the charts and executing your trades. But beware, indicators are often lagging. This means that they are based on data from the past, so the situation has already occurred and this execution is always lagging behind. Also, the more indicators you want to use, it doesn't really provide you that much more information than you need. Often you don't need the indicator, or it's just a similar indicator to the one that you've been using already, and then you're just confusing your own thesis. Personally, I'm not using many indicators, as most indicators are based from price action and you will need to understand price action first. Up to you. If you want to build your strategy, you can use whatever indicator you want. Thanks for watching this update on basic indicators. Make sure to hit that like button and also make sure to subscribe to this YouTube channel beneath to stay tuned on the latest content. If you want to use Tradingview and you don't have an account yet, click on the link in the description beneath or in the bio of the video and I'll help you further. Stay calm and patient and I'll see you again tomorrow in the live stream. Ciao!